Retirement. The dream of not waking up to an alarm clock, the freedom to travel, pursue hobbies, or simply relax without the constraints of work. For many, retirement feels like a distant goal, something that requires decades of planning and saving. But what if you could retire earlier than you think? How much do you really need to retire comfortably? And is early retirement truly within reach? The idea of retiring early has gained traction in recent years, largely thanks to the FIRE movement, financial independence, retiree early. People are increasingly asking, how much money do I need to retire early? Let's break it down step by step so you can understand how to plan for early retirement. Figure out how much you need to save and make the dream of financial independence a reality. 1. The basic concept of early retirement. At its core, early retirement means having enough money saved and invested to live off of without needing to work for a paycheck. The goal is financial independence, the point at which your assets, typically a mix of investments, generate enough passive income to cover your living expenses. While traditional retirement at 65 or older might seem far away, many people aspire to retire in their 40s or 50s. Some even aim to retire in their 30s. The big question is, how much do you really need to retire early? The answer depends on several factors: your lifestyle, where you live, your desired retirement age, and most importantly, how much you're willing to save and invest. 2. The 4% rule, your guiding principle. One of the most popular frameworks for determining how much you need to retire early is the 4% rule. This rule is based on the idea that you can withdraw 4% of your savings each year, and your nest egg will last for 30 years or more without running out. This has been the foundation of many retirement planning strategies. Here's how it works. If you want to have $40,000 a year in retirement, you'll need a nest egg of $1 million. $1 million times 4% equals $40,000 per year. The 4% rule is based on historical market returns and assumes a balanced portfolio of stocks and bonds. However, it's important to note that the rule is not a hard and fast law. It's a general guideline. You might need to adjust it depending on your circumstances, lifestyle, and the state of the markets when you retire. 3. How much do you need to retire? Let's do the math. The amount you need to retire early depends on several factors, but primarily it comes down to your annual living expenses. To calculate how much you need, follow these steps. Step 1. Determine your annual expenses. Start by calculating how much money you need each year to live the lifestyle you want. This includes housing, mortgage, rent, utilities, property taxes, food and groceries, healthcare and insurance, transportation, gas, car insurance, public transit, entertainment and leisure, travel, dining out, hobbies, savings and contingencies. For example, let's say your annual expenses total $40,000. Step 2. Multiply your annual expenses by 25. Once you know your annual expenses, multiply that number by 25. This is based on the 4% rule mentioned earlier. Here's the math. $40,000 times 25 equals $1 million. So, in this example, you'd need $1 million saved to retire with $40,000 per year in passive income, assuming you can withdraw 4% of your total savings annually. Step 3. Factor in your retirement age. The earlier you retire, the more you'll need to account for. If you're planning to retire in your 40s or 50s, you'll need to save more to cover a longer retirement period. The 4% rule assumes a 30-year retirement, but if you retire earlier, you could be looking at a retirement lasting 40 or 50 years. This means you might want to aim for a lower withdrawal rate, like 3.5% or even 3%, to account for the additional years of retirement. If you're planning for a longer retirement, you might need to multiply your annual expenses by 30 or 33 rather than 25. Let's say you plan to retire at 45 and expect your retirement to last 50 years. Using a 3.5% withdrawal rate, you'll need $40,000 times 30 equals $1,200,000. Step 4. Consider inflation and healthcare costs. Inflation and healthcare costs are two critical factors to keep in mind. Inflation means that the cost of living will increase over time, eroding the purchasing power of your savings. Healthcare, especially as you age, can be one of the biggest expenses in retirement, and you'll need to plan for that, even if you're retiring before you reach Medicare eligibility age. 4. How to reach your early retirement goal. Now that we know how much you need, how do you actually reach it? Here are the key steps you'll want to take to retire early. 1. Save aggressively. To retire early, you'll need to save a significant portion of your income. Many early retirees aim to save 50% or more of their income, often by cutting back on unnecessary expenses and focusing on high-impact saving strategies. The more you save, the faster you'll reach your goal. 2. Invest wisely. Savings accounts won't get you to early retirement. You need to invest your money to see it grow. A mix of stocks, bonds, and real estate is typically the best approach. Low-cost index funds, or ETFs, are a popular choice for early retirees, as they provide broad exposure to the market with minimal fees. 3. Automate your savings. Set up automatic transfers into your investment accounts to ensure you save consistently. Automating your savings takes the guesswork out of it and makes sure you don't skip contributions, even on the tough days. 4. Reduce your lifestyle inflation. One of the biggest barriers to early retirement is lifestyle inflation. This is the tendency to increase your spending as your income increases. For example, when you get a raise, you might be tempted to upgrade your car or take more expensive vacations. If you want to retire early, you'll need to resist lifestyle inflation and keep your spending under control even as your income rises. 5. Live below your means. Living frugally isn't about depriving yourself. It's about making intentional choices that align with your values. For example, instead of buying a new car, consider driving an older, more reliable one. Cooking at home rather than dining out and cutting back on unnecessary subscriptions can save thousands over the course of a year. 5. Consider alternative income sources. One strategy for early retirement is to build alternative income streams that supplement your savings. These could include rental income from properties you own, side businesses or freelance work, dividends from stocks, peer-to-peer lending or other investments. Creating multiple sources of income allows you to be less reliant on a single stream of income and gives you more flexibility to retire earlier. 6. Downsizing and relocation. How to stretch your dollars. Another strategy to accelerate your path to early retirement is downsizing. Moving to a less expensive home or even relocating to a lower cost of living area can significantly reduce your annual expenses. This might include moving to a smaller home, relocating to a more affordable city or country, cutting down on discretionary spending. You don't have to live in a mansion to be happy in retirement. By focusing on what truly matters, health, relationships, experiences, you can enjoy a fulfilling early retirement, even if it's on a smaller budget. 7. Final thoughts. Is early retirement really possible? The short answer, yes. With the right mindset, planning, and discipline, early retirement is absolutely possible for many people. It all comes down to how much you save, how wisely you invest, and how you manage your expenses. Remember, the key to retiring early is building financial independence, not just amassing a huge nest egg. Focus on what matters to you, make sacrifices in the short term, and invest in a way that helps you achieve long-term financial freedom. Early retirement might seem like a lofty goal, but with the right approach, it's within your reach. Thank you for watching. If you found this video helpful, be sure to like, subscribe, and share with someone who's interested in the possibility of retiring early. Do you have any tips or questions about early retirement? Leave them in the comments below. Let's make this dream a reality together.